Welcome to The Other Side of the Coin, where we bring new perspectives to the decisions shaping your business, finances, and life. Today's guest is a business valuation expert and best-selling author, Dave Bookbinder. Dave is known as an expert in his field, and he is the person that business owners and entrepreneurs reach out to when they need to know what their most important assets are worth. Dave is the author of 2 #1 best-selling books about the impact of human capital on the valuation of business enterprise, called The New ROI, Return on Individuals, and The New ROI, Going Behind the Numbers. Another book of his, A Valuation Toolbox for Business Owners and Their Advisors, is an Amazon top new release. Dave is also the host of an award-winning business podcast, Behind the Numbers, which is enjoyed in more than 100 countries. Without further ado, it is my pleasure to introduce Accredited Senior Appraiser, certified in Entity and Intangible Valuations, and author, Dave Bookbinder. Dave, welcome to The Other Side of the Coin. How are you doing today?
Great. Thanks for having me, Zach. Great to be with you.
Very excited to have you here. I think your expertise and the topic of today's conversation is so fitting. We always want to talk about the areas that are least understood by people, the most overlooked areas that add the most value. And when it comes to business owners, I think your line of work of being a valuation specialist, I think there are so many unknowns to business owners with what you bring to the table. So I'm very excited to jump in. I usually let Mike do the open and ask the opening question, but let's jump right in. And the first question that we like to ask all of our guests is, what was your relationship to money when you were growing up?
My relationship to money, I guess, was one of it's not something to be squandered. My parents both worked really, really hard. Mom was a bookkeeper. Dad worked 2 jobs, and they worked very hard for their money. And it was very, very clear that you don't just spend it frivolously.
That's excellent. And was money something that was discussed in the household or around the dinner table, or was it more of a taboo topic in the household?
I wouldn't say it was a taboo topic. I mean, I think money became more of a conversational topic as I got older. Growing up, I was more interested in baseball and football and outdoor stuff and getting my knees scraped and doing those sorts of things. So I had bigger fish to fry. It wasn't on my mind. Let's put it that way. I never felt like I was lacking or wanting anything, so it never came up in my conversations.
Could you, Dave, take us a little bit? You can give the 5 minutes or less version of your journey. Like what brought you into valuation services? What's important to you about that? 30,000-foot view. How did you get here?
So you wouldn't believe me if I told you that when I was like 6 years old, I wanted to be a valuation analyst, would you? I didn't think so. Okay. So I was working during the day at the IRS, not doing taxes. I was actually doing some computer work for the IRS and going to grad school at night. And I knew that I wanted to do something with my MBA in finance. Wasn't sure what that was exactly. Honestly, originally thought I was going to be what you do, Zach. I was really interested in managing money. So my master's is in finance/investment management. But as I started to go through the corporate finance classwork, it became really intriguing to me about valuation and so forth. And as I was looking for jobs, I found something on the job board at school, and the position description sounded a lot like what I was doing in the MBA program, and wound up pursuing that. Interviewed for the position, and that's what got the whole train rolling for me. So, what was the other part of that question, Mike? What's the most interesting parts of it? Is that what you said?
Yeah, well, what brought you into the fields that you're in?
Okay.
What
Well,
feels important about it to you?
yeah, what feels important about it to me is it matters for my clients. So there are certain circumstances where valuation is certainly important, but it's given short shrift. And an example may be, think of a public company. They're doing a filing and they need some valuation analysis done. It's basically a check the box. Sure, it's important. It's got to be SEC mandated. It's got to pass muster with their Big Four audit firm. All that good stuff, right? But the CFO or the CEO doesn't go home at night and put their head to the pillow and wonder about what was that report that was just delivered to them. However, when I work with the business owners and the entrepreneurs, this stuff really matters to them. And look, valuation is not life or death. My wife's a nurse. What she does every day, she's saving lives. What I do, not even close to that. But when I'm working with privately held business owners, sometimes what I do is almost as important.
Mm-hmm.
No, I think a lot of the times when we're on the podcast speaking with guests, a lot of the times we get into the mindset and the mentality and the ethos of things. I'm actually curious to get a little bit more analytical and a little bit more tangible. I'm curious, when you're working with your clients, what are some of the key value drivers that you're looking at in order for them to strategically improve the value of their company?
Got it. So that's a great question, Zach. Usually my work starts with the client in terms of figuring out what the business is worth at a particular snapshot in time because they're doing a thing. So maybe they're gifting shares to their kids and they're doing it as of December 31st. So what's the business worth as of December 31st? That's where we start. Usually it's an eye-opening exercise for them as we start to talk about what goes into the analysis, the methodologies that we use to value businesses. And then from there, it's a natural springboard to talk about the ways you can actually grow and enhance the value of your business. And we can go as deep as you want. At a very high level, the thing that I always share with my clients is valuation is all about balancing risk and return. Valuation's forward-looking, and what really matters is what does the future look like? Buyers and investors are really concerned about what the future is, and the math is essentially a present value calculation of the future benefits brought back to today's dollars at the right risk rate. So anything you can do to de-risk your business is going to increase your valuation, and there are ways to de-risk, and we can talk about that if you'd like to.
I think that's a great way that you just phrased that. Maybe you want to shed some light on that, go a little deeper.
Yeah, sure. So there's a couple components that you can think about in terms of de-risking. One is the veracity of the data that you have. So a lot of times companies are working with financial statements that are, call them less than stellar. Maybe they've got family members on the books that maybe haven't worked in the business for 6 years and they're still getting a paycheck. Maybe I'm exaggerating the example here for you just so you get it, but maybe they've got their personal jet on the books as well. So these are things that when a company is getting ready for a sale event or capital raise, they've got to be normalized away. And you spend a lot of time having a conversation about what should be or should not be on the statements, making the adjustments to reflect what the proper earnings or EBITDA might be. So if you're going to embark down that road, best advice you can do is get some financial statements that you can literally hand to a buyer or an investor that they can rely on, whether it's a review or an audit, depending on the size and the nature of your business. But something that isn't homegrown and something that's really clean. That says that you're serious. That says that you've run a clean ship and a clean operation. It lowers the temperature in terms of how they view you in terms of the risk profile. Okay. And the other classic example that I've seen, and then I'm going to shut up. The old hockey stick forecast. I think you guys know what I'm talking about. Business has been chugging along, 5% a year, 5% a year. Now suddenly next year we're going to grow at 48% and 172% thereafter. So it's the flat line and then the shaft of the stick. That's why it's the hockey stick projection. More often than not, those are not really viable forecasts. Usually it's somebody trying to paint a rosy picture because they're trying to achieve some imperative. And your buyer or your investor will see through that. They're going to ask you the tough questions, as will I. But how do we get there from here? You ain't done it before. How are we getting there now? And unless there's some really compelling story, we're going to have to take a closer look at that. And that speaks to risk.
I have one more follow-up, and I feel like I have 100 questions for you. I always think it's so insightful when we speak, but I want to make sure that Mike can, bring some questions to the conversation as well. What do you think are some mistakes that business owners make when they're trying to increase the value of their business?
Yeah, that's another good one. I actually wrote an article about the top 10 mistakes that business owners make when valuing their business. So you can find that on my LinkedIn profile. There's a couple, and I actually recently had to modify the article to make it the top 11 mistakes. because I saw something that was just absolutely horrific online. And there's a lot of bad advice out there. One thing you may hear, people will say, just give me a back of the napkin or a back of the envelope estimate for the value of the business. And what they're meaning, another term they use is the quick and dirty. Well, you get what you pay for, and the back of the envelope and the back of the napkin methods are not valuation methods. So that's number one. When they go to cocktail parties and somebody's brother-in-law who's in investment banking says your business should trade at 10 times EBITDA, a lot of times they latch on to that and think that's what my business is worth, but they don't have context. So first of all, how do you define EBITDA, right? Some of them don't know how to spell it, but how do you define it? What goes in, what comes out? That's the first part, right? Then what was EBITDA last year? But again, what's EBITDA going to look like next year and the year after that and the year after that? Then the other context that's very important here is, are we talking about the sale value of your business, which represents a controlling interest on a marketable basis? Are we talking about a minority interest position in a non-marketable business because you're going to gift 2% of your company shares to your grandkids? Completely different set of value propositions there.
So EBITDA, earnings before interest,
taxes, depreciation, amortization. It's a proxy for cash flow. It's a great way to normalize two businesses where maybe if you're doing a comparison of two different companies and one is heavily invested in, say, machinery and equipment. So maybe they're using leverage. They've got interest expense. They're depreciating the equipment. So they'll have different expenses than somebody who's not in that space. By using EBITDA, you move it up the line so you can compare people on an apples to apples basis. I actually have another article about EBITDA that goes into what it is, how you calculate it, why it's important, and more importantly, why it's not the silver bullet evaluation, because everybody tends to want to rely on EBITDA.
Could you share what were like 2 or 3 of the mistakes? And I'm definitely curious what mistake number 11 was.
Number 11 was a gem, Mike. So a business owner was online saying that business owners don't need evaluation. They're costly and they take a lot of time to prepare. Neither one of those statements is correct, by the way, but that's what this guy was saying. So he tells his audience or the readers of this article, here's what you need to do. Okay. Go to this website. All right. Look up your industry's EBITDA multiple and then multiply it by your company's last year's sales. Now, did you hear the nuance here? You're going to take an EBITDA multiple, which is questionable to begin with, because you've got to have some analysis. There's not just a generic multiple for the industry. We're going to multiply your sales by your EBITDA multiple. So immediately he's blowing up the equation, and it makes no sense. And people are going to rely on something like that, and that's wrong.
You know, when our firm is working with business owners and we're really bridging the two worlds together of their business planning and their personal planning, we always talk about how the external economic factors have a large play in what they're going to walk away with on the personal side, right? Because after you sell your business, you're going to have to do something with the dollars. I'm curious from your side of the equation, what's the role of economic factors and kind of like current events that are happening? How do you explain that to clients, and is there anything for them to look out for?
Well, valuation is always a snapshot in time. So like I said before at the beginning, if we're talking about, for example, valuing the shares of the business at December 31st because we're going to gift some shares, that's the period that we do the so-called cutoff. So what are interest rates at that point in time? What are the transaction multiples at that point in time? So that gives the framework. So that is what it is. Going forward, what's the expectation for the growth in the industry and the economy and the company in particular? But I want to expound on something that you kind of alluded to, Zach, which is something I share with my clients. Because a lot of times when they're going to market, 'cause I'm also a former investment banker, and when companies are going for sale, a lot of times valuation is a critical issue for them, maybe even the most critical one. How much value can we squeeze out of the deal? And what the reality is, they don't have to necessarily get the last nickel on every transaction. What they really should be focusing on is the best fit buyer for them, the best circumstance and outcome for them, whether they want to stay in the business, whether they want to take another bite of the apple with maybe some rollover equity, or how are their employees going to be treated by this particular buyer? Because if they get enough proceeds, somebody like yourself can invest those proceeds, allow them to live the lifestyle that they want to live and do the other meaningful things that they still want to do.
Yeah, I think that's a great point, right? There's a difference between a financial buyer and a strategic buyer. And I think at the end of the day, it really matters what the owner is trying to achieve. And that's going to influence, maybe how, rigorous they want to be about the term deal, the offer that they're going to be receiving from people.
Mm-hmm. Yeah, because look, all these things happen under various sets of circumstances. Some people are selling because it's part of a long-term strategic plan that they've thought out from day one. Some of them are selling because they have an uh-oh moment in their life where somebody got sick, somebody died, business partner divorce situation, and now they're compelled to sell. There's a lot of different reasons. Sometimes there's an unsolicited offer. Somebody shows up and says, hey, we've been in your space for a long time, and we know you guys, we like you, and we want to buy you. Now what? So a lot of different circumstances that arise here in terms of when somebody's actually going to market and how they should be thinking about the value.
What do you say to business owners if they're trying to, quote unquote, time the market and they're waiting really for kind of like economic factors to be at their height? Like we're just describing how, you have these external economic factors, and really, I believe it's really about finding the correct buyer, not about the correct timing all the time. So what's some recommendation or advice that you give to people if they're really stuck in this waiting pattern of, when there's this perfect time to sell their company?
I love using the analogy of the house. So for everybody out there who's watching or listening, if think about every time you sold your home, did you do it because you were trying to time the market and maximize the value of the home? Or were you doing it because you had another set of circumstances that drove the need to sell the home? That's usually what happens with the business owner too. There's usually another set of circumstances that's going to drive it. Sometimes you get the luxury of thinking about when should I go to market, and you can look at multiples and trends in the industry and talk about is now the right time. And you could have somebody else on the program to tell you, yes, you should absolutely time the market, and yes, you can absolutely do it. I think you can still get good value in any market if you've got the right situation in place, you've done the right things for your business, you've done the proper homework and preparation, and you made your business saleable. And again, it comes back to the de-risking. You've got the good set of financials, you've got procedures in place, you've got a good team around you, and you've got a business plan that's based on sound, reasonable underpinning assumptions that you can demonstrate based on what the track record of performance has been. So yeah, springboarding off of that, if last year was a down year for you, does it make more sense maybe to wait until it comes back the following year so you can jump off of a larger point? Sure, that's something that you definitely want to consider if you have the luxury of time to do something like that. But again, it's all facts and circumstances.
Yeah, I really like that house analogy. I think that's really spot on.
I use that a lot in a number of different ways, especially in describing a market-based approach to valuation.
So Dave, I want to change gear, unless Zach, if there's more technical components that you want to press on. I'm keen to explore the human side of valuation here. And so Dave, I'm gonna read back a quote that you have. It's from your book. Discretionary effort is the holy grail of employee engagement. The going above and beyond drives business valuation. And I'm curious, so if discretionary effort is the holy grail of employee engagement and going above and beyond determines valuation, I'm curious, like, what else goes into valuation on the human side of things?
Yeah, oh man, we could spend hours talking about this. Let me ask you guys this. It's a loaded question, so I don't mean to put you on the spot. You've heard every CEO on the planet say our people are our most valuable asset, right? They pound the table. Do you know where that most important asset or most valuable asset appears on a financial statement?
It does not.
Exactly. When you think about people, usually people think about expenses, right? Salaries and benefits. So people actually in the valuation world get subsumed into goodwill. It's a rabbit hole. I'm happy to go down if you want to. Your audience may not enjoy that conversation though, but we can certainly go there. Suffice to say that from my lens, I've been doing valuation for longer than I care to admit. I valued a lot of intangible assets throughout my career. One of those intangibles is people. And we only value the assembled workforce when a company acquires another business. And we're only valuing the acquired workforce. So there's already a disconnect there, right? Then the methodology that we use to value those people is a cost to replace method, which basically assumes that people are fungible. You're all the same. And I would argue, and most reasonable people would agree, that an engaged employee is probably worth more than somebody who's disengaged. Somebody who's been with the organization ostensibly could be worth more than somebody who's only been there for 15 minutes because they know some of the institutional knowledge, right? So we don't give any consideration to things like that. And the books represented my journey to prove that people really are a company's most valuable asset. And what I really took away from this, Mike, was that while, yes, there are different ways we can value the workforce and we can make changes in how we can do that in a more robust way, nobody really cares, I don't think, until people wind up on a balance sheet. So my lens in this conversation is the impact that people have on the value of the business enterprise. Because if I tell a CEO that if you do the right thing that starts with leadership and you can create a great environment, a great culture, that's going to help in driving the discretionary effort, which is going to then result in greater productivity, which is going to result in greater numbers, which is going to result in better business valuation, all things equal. You guys know what the average engagement rate is in the U.S. today?
So
What percentage of the workforce?
I was actually about to mention, I'm curious if the numbers line up. I was in a meeting this morning, and this was actually pretty prevalent to the conversation. And what I was told this morning is that through a Gallup study, they said that 23% of employees are actively engaged.
Okay, actively. So I've got a statistic that says it's either 32 or 33%. So 1 out of 3
Okay.
people shows up for work today
How would
interested in being
you
there.
qualify it? Like engaged, if someone was reporting on that, what are they looking for? What does
Okay,
engaged mean?
so engagement represents the emotional commitment to what they're doing. So it
Mhm.
manifests itself in things like teamwork, collaboration, cooperation, good attitude, the going above and beyond. You know who those people are, right? And you also know what the flip side is. And maybe that's the easier conversation. What does disengaged look like? Bad attitude, show up late, don't do what they're supposed to do the bare minimum to get by. Maybe they're argumentative. Those are the differences. But think about it. The analogy I like to use is if you think about engagement in the context of, say, a lifeboat, right? So if you've got 10 people on a lifeboat, you got 3 up front that are rowing really hard to get you to safety. You got 4 in the middle that are just kind of looking around at the icebergs. And you got 3 in the back who are trying to sink you. So what if you could take the engagement needle, turn a little bit to the right and get that number up just a little bit higher, create a better environment where more people are rowing in the same direction, rowing in the right direction? What's the impact of business value?
Mm-hmm.
And what are the recommendations that you make to business owners in that regard? Obviously, you have different, retention and compensation. What would you add to that in order? I mean, there's culture, there's a cultural aspect, right? What would you add to that though, and how to help a business owner create that?
Yeah, so there's a lot of components that go into that. And I've interviewed a lot of CEOs and folks that are helping CEOs and implement culture change. And a couple of key takeaways that I hear all the time. Number one, you need to be intentional. If you're going to do this, you're going to institute some kind of culture change. You have to do it for real. Okay. A lot of your employees have seen the gimmicks, right? They've seen the ping pong tables in the break room. They've seen pizza on Fridays and so forth. Doesn't move the needle. It's a nice to have, probably table stakes if everybody else in your industry has the ping pong table in the break room. But what people are looking for is that emotional commitment that's going to make them feel engaged. They want to feel like they're doing something that has a greater purpose than just making a widget or delivering a valuation report or delivering a tax return. What value are you adding to that client or customer experience? And they need to feel good about what they're doing. They want to feel appreciated. They want to feel valued. They want to know that what they're doing matters. And the CEOs I talk to say that to do culture change right takes 18 to 24 months before it really gets embedded into the DNA of the organization where people really believe that you're serious about it.
Everything that we're talking about is obviously leading to driving valuations for businesses. I'm curious, just in simplistic terms, how early should businesses be, looking at their valuation, and not only how early should they be looking at it, but how frequently should they be revisiting it?
Yeah, and there's a lot of different ways to skin that cat, Zach, because you should be thinking about it always. Um, and there's a lot of different ways to do it. Most clients are thinking about valuation, like I said before, when they're doing a thing, right? And their lawyer or their accountant says you need to get your business value. The good strategic ones are thinking, how do I benchmark myself to my peers? Who do I want to be when I grow up? What are the companies that I want to look like? So as I grow as a business into the industry, if you have a knowledge of what those other companies trade at in terms of revenue multiples, EBITDA multiples, it gives you a good guidepost for how you could be thinking about your growth and where you might fit into that. Similarly, if periodically, once a year maybe, you do a reset on recent transactions in your space to understand what companies have been sold for in your industry. That's also good data, and that's a good valuation metric for you to think about. So you're not just doing the wet finger in the air or that back of the napkin method. You actually have some real data to point to, and it helps you to really facilitate a good strategic plan because you don't know where you're going, right? If you don't have the data to help you get there.
Yes, certainly. Mike, were you going to ask something?
Yeah, I'm curious. There's a lot of things I'm curious about, but I would love to hear like I imagine a lot of CEOs and executives are convinced that they're not just doing the ping pong tables and the pizza Fridays. They're like living and breathing the culture. And then behind closed doors, all the employees are gossiping and talking about how it's all phony baloney. And I'm curious, like how you would have someone at the executive level, whether it's a small business or a large Fortune 500 company, how are they benchmarking? Is this actually being implemented successfully?
You touched on a really important topic there, Mike. That was one of the springboards for me because I remember it like it was yesterday. I was going to visit a client and I was sitting in the waiting area and they had a big billboard type sign framed and it says, "We value diversity and culture here," something to that effect. And I thought to myself, wow, that must be so cool to work at a place that really says that right in your face as soon as you walk in the door. And CFO greets me. We're walking back to her office. She shuts the door and I said, how cool is it to work here where they really respect you and value you like it says on that billboard? And she leaned in. She said, that's BS. They don't do that. I'm like, oh, you're kidding me. What I hear from time to time is there are a number of organizations that really have CEOs that get it. But I hear all the time that the guy in the Charlotte office didn't get the memo, didn't drink the Kool-Aid. So somebody came on my show and made the point recently that culture is local. And you can relate to this because the culture on the marketing floor on number 4 may feel a little different than the culture on the finance floor on floor number 7. So it's imperative that everybody's doing the right check-ins. You can do various types of survey data to take the temperature of your employees, but it's important that the leaders communicate and hold their underlings, the managers and so forth, accountable to living the values. Because if it's not a part of the DNA, it's not going to work.
Mm-hmm.
Yeah, it's so true. We work with some businesses where they have multiple office locations. And even though they all have the same goal, and even though they all have the same values, each office really does have its own DNA, right? Because you have different people in each office. I'm curious if this would give any value. I know that you've been doing this for a long time and you're very expert in your field. Is there anything that you would say to your younger self? Is there anything that you wish you knew when you first got started in the valuation space that you know now that is maybe like a PSA for business owners?
Well, one of the interesting things was, and this was an aha moment for me, because when I started out in my career working with privately held businesses, a lot of times the data I would receive was less than perfect, right? And I always thought, man, when I start working with those publicly traded companies, I'm going to see something that really looks head and shoulders above. And when I started working with those businesses, I realized, they didn't always have their act together either. But I guess the big takeaway for the business owners, just in the context of this conversation, is twofold. One, your business is a function of the risk going forward, right? And your most valuable asset is your people. I think people are the last bastion of value creation. Your assets go home every night. Those are the ones that are going to make you or break you. They can go on Glassdoor tomorrow and trash you, where they can go on Glassdoor and tout what a great place it is to work and help you with recruitment and retention and just all that other good stuff that engagement creates.
Are you making recommendations, especially while a business is going through a transition or a transaction? Are you making recommendations to the business owners on different ways of retaining their key people throughout that transaction? Obviously, that's very valuable for the buyer to know that the people who are really, putting the oil in the machine are going to stay there throughout that transaction.
Yeah, look, that's a tricky one. I'll be honest with you. Sure, I think there's a lot of business owners who want to protect their people. There are some circumstances with buyers that feel that there's duplication in efforts and departments, and they've got their own way of looking at what the post-deal new co is going to look like, and unfortunately, sometimes that results in downsizing and layoffs, and that's unfortunate. But that's corporate America, I guess.
Yeah.
I'm curious if you could speak about hiring too, because I know this is actually something that Zach has experienced in the last couple of years. As a business expands, usually there becomes a need to recruit other talent. And so I guess this isn't so much a valuation. It feels like a little bit like a valuation question in that you've probably become really adept at identifying, even if the technical proficiency is not there for a certain industry, like what are you looking for in people in terms of like what makes for a valuable person, I guess, whether you're hiring or like promoting within.
Yeah, I'm going to get to that in 1 second. Let me ask you guys a question. It's another trick question. Are you better off hiring a rock star employee because everybody's looking for the next rock star? Or are you better off avoiding the toxic employee?
Has to be avoiding the toxic employee.
Exactly. That's why I say it was a trick question. There's actually Harvard data that I talk about in the first book. You're actually better off not looking for the rock star, but just avoid the disaster because it's way more costly. To answer your question, though, Mike, I've never hired based on the technical skills. If I'm looking, especially in a junior position, for a senior position, sure, it's a different story. But if you're talking about a younger professional, the biggest things for me are intellectual curiosity, great attitude, gets along well with others, could be a good culture fit for the team. Because most of the time we can teach them the other stuff. So that's always what's worked best for me.
We're talking about all these other businesses. I was also thinking about your business, Dave, and I know the firm that you work for, but more from the perspective of the business owners. Who are the professionals at the table that these business owners need to surround themselves with in order to, put themselves in the best position possible during these transactions?
You have teed me up for so many articles, so I'm going to cite another one. So thanks for that. You don't even know you're doing it, but
I need to find red flag number 12 for you somehow.
Yeah, you let me know. I'm sure it's out there. So the article you just teed up here for me was thinking of selling your business. Here's 5 things you need and 1 you don't. And the one you don't is necessarily is evaluation. And it's a story that happens to me a lot where somebody calls and says, hey, I'm thinking of selling. I need evaluation. And this was the account of one particular day where I got to the potential client's office, and before my butt even hit the chair and had the coffee in my hand, he was already to sign an engagement letter. God, just let's do this. I need to sell. I need to know what I'm worth. And the more we got into the conversation, the more it became apparent to me he didn't need me. Had he called me 6 months earlier or 18 months earlier, I could have helped him and added great value. But he was in that moment where he needed to sell and put that for sale sign on the front lawn. So to answer your question, what you need. At that point, I made an introduction to an investment banker for him to help him with the auction for the business. He needs an accountant, a good accountant that can help him. And sometimes business owners need to recognize that there's a progression, and the accounting firm that you've been with for the last 5 years may not be the one you're going to be with for the next 5. There's different levels of skills and expertise, and sometimes you've got to do that. And certainly if you've been working with Aunt Rosemary, who was the bookkeeper, it's time to get a real accountant. The other thing is the real deal attorney, an M&A advisor, not your brother-in-law, the personal injury attorney. All due respect to personal injury attorneys. Probably don't want them papering an M&A transaction for you. You need a wealth manager, right? As we talked about before. You're going to come into some proceeds and you need to have that money managed for you. You may need a valuation guy, you may not. But you need to put together that core team. But the most important thing is you need to designate somebody to be a quarterback. Everybody has to be talking to one another so that they're all working for your interest, Mr. or Miss Business Owner. If your team isn't working together, then it's just a bunch of siloed advice and you're not going to get the most value out of that.
Yeah, certainly. And also, I don't know why you just made me think of this. Maybe this could be another article for you, but
Maybe I already have one for you. Let's see where this goes.
maybe. And any insight on when businesses are receiving letters of intent? Sometimes I'm in situations where a business owner might only be receiving one letter of intent. Maybe you can discuss just the value of working with like an investment banker, for example, to make certain that there's more than one pursuer at the table and, the value when you have more than one potential buyer.
Yeah, I love the house analogy again. I used to think of myself as a smart guy, and there was a time where I thought, yeah, I don't need a realtor. I can sell my house. And I tried it for a while, and then I realized it's not my wheelhouse. Same deal. If you're a business owner, your primary task is to run your business, right? Keep that going. So if you're lucky enough that you've now gotten an LOI, I'm guessing it's an unsolicited offer. There's a couple of things that happen here. Number one, is it the right time? Is it the right value? What's the circumstances surrounding it? And then how do you negotiate that? How do you navigate that? And you could run the risk as a business owner who doesn't involve themselves ostensibly in transactions day to day, not know what to ask, the blind spots of don't know what you don't know. I'm a big believer in having somebody else be the bad guy, ask the tougher questions. If you're going to actually sell your company, and we're doing not the unsolicited LOI, but we're going to have a strategic plan, we're going to be thinking about selling our company in some period of time, and now we're going to go to market with a thoughtful plan. Being represented by a professional adds so much value. Yes, you pay a success fee, and I'll tell you it's worth it, and here's why. Because when the buyer receives information memorandum number 17 in the lower right-hand corner, they know that 16 other buyers have gotten information memorandums, and this is a serious process. It's being conducted by somebody who knows what they're doing. They've been there and they've done that. And if this buyer wants to participate, they're going to have to sharpen the pencil and get in the game for real, for serious. Not try and steal a business, buy a business, hoodwink a potential partner because they don't know what to ask in terms of how to structure a transaction. Pay the professionals. I'm telling you, you'll be very glad that you did.
Yeah, it's an investment, not a cost, right?
Mm-hmm. Oh yeah. Yeah. Blind spots is the biggest thing. You've got to protect the blind spots because we haven't even talked about there's tax considerations to these things too. So that's why you want to get your team of advisors around the table and looking at this thing for you from every possible lens.
Well, I'm curious, Dave, is there anything that we haven't covered so far today that feels important to bring into the conversation now as it pertains to what we've already spoken about?
Yeah, I appreciate that because I'd like to tie it up this way. When you read the quote, I wasn't sure which one you were going to use. I've got a bunch of them that are out there that have been shared, but there's one in particular that's been shared around the world. And I think it pulls everything together cohesively here. And it's that the value of a business is a function of how well the financial capital and the intellectual capital are managed by the human capital. So you better get the human capital part right. That's it. That's the poster. That's your tweetable moment.
Could you repeat it one more time?
Yeah, sure.
Yeah.
The value of a business is a function of how well the financial capital and the intellectual capital are managed by the human capital. You better get the human capital part right.
That feels like a good note to move to the back end here. Zach, was there anything else that you wanted to ask?
No, I really appreciate everything that you've given to the podcast today, Dave. Obviously, you're a wealth of knowledge, and I really enjoyed the conversation and having the opportunity to pick your brain. So just thank you so much for, taking the time to shed some light on valuations and when business owners are looking to sell their company and some of the red flags to look for, some of the opportunities that might be right under their nose that, they're not aware of. So I think this was just a very insightful conversation. I really thank you.
Well, it's my pleasure. I appreciate the opportunity. Always thrilled to talk about valuation, human capital. And if your audience is interested in connecting with me, I'd invite them to look for me on LinkedIn. I'm always happy to chat and have a conversation. If they're interested in the books, they can go to newroi.com, learn more about those there, or on Amazon. They're available everywhere you get your books. And if they want more of me, I've got a podcast also. It's called Behind the Numbers with Dave Bookbinder, and you can get that anywhere.
Yeah. Well, before we let you go, Dave, and I thank you too for the wealth of knowledge and information that you brought. And speaking of wealth, we like to close the conversation with, it could be a philosophical question, it could be a practical question, but we would love to know in your world, what does it mean to be wealthy? What does that mean to you?
Freedom.
Easy peasy.
That was the shortest answer we've had so far.
One word answer. I love it.
Yep.
Yes.
Money can't buy happiness.
I think that's fair.
But, it may give you some opportunities to do some things that could make you happy.
Yes, it can.
A tool
I'm not talking
to
about, buying, new shiny objects.
a tool to give you what you actually want.
Yes.
Yeah.
Well, thank you, Dave. Thank you for spending some time here on our show. You brought a lot of value, a lot of information, and
Anytime, guys. Happy to be here.
I'll do Zach's little spiel here too. If anyone who's still tuned in here, it shows something about you, that you are investing some time in educating yourself about business, about yourself, about your mind. And it's a vote of confidence in yourself that you pay attention to something like this. So thank you all for joining us. And Zach, any final parting words?
I guess my parting words are, if you want to be great at anything, it takes effort and time and discipline and education. Success doesn't happen randomly. It's not lucky. You create your own luck. So I think working with people who have walked the terrains and who have experience, achieving different tactics on what we're talking about here today, it really does make a world of difference. So once again, Dave, thank you. Mike, thank you as always. And we will catch up with everybody soon. Thanks so much.
Take care, everyone.
Hi, everybody. This is Zach Smith, co-founder and CEO of I Am Financial and the co-host of The Other Side of the Coin. Please remember to subscribe and like. And if you have any questions and or would like to speak, please feel free to email me directly at zacksmith@im-financial.com. That is ZAK Smith at the letter I, the letter M-financial.com. Reach out to us and we will make certain to get you to the appropriate channels. Thank you again, and we hope you enjoyed our show. See you next time. Disclosures. This podcast is for informational purpose only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and the firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, Northeast Financial Network, and I Am Financial, and the opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, and accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. OSJ address is 101 Crawford's Corner Road, Suite 2405 in Homedale, New Jersey, 07733. Their phone number is 908-709-0020. Our phone number is 914-603-8325. A member of the Northeast Financial Network, financial representative with Guardian Life Insurance Company of America, New York, New York, I Am Financial, and Northeast Financial Network are not affiliates or subsidiaries of Guardian. Arkansas license number 16303-838, California license number 4108463.
Submission number 8901-002.1, expiration 5/28.